Welcome to um, short call or selling a naked call. So we will talk about what is a short call. So when you sell a call option, you are giving the buyer right to purchase the stock at a specific price. It's also known as strike price, for a given expiration date. For this, because you're taking a risk, you are collecting a premium. Naked call is a type of option strategy where an investor writes or sells a call option without owning the underlying stock. That's why it's a little risky. Why sell a call option? Have you ever wondered a particular stock, for example, Tesla, already reached the ceiling and can't go too much higher? If you think that's the situation, you can sell a call option at a higher price and collect a premium. Typically, you sell call option when volatility is high, so you get a bigger premium. Maximum profit is really the premium that you collected when you sold the call option. Maximum loss, though, is unlimited if the stock rises exponentially. For example, Tesla can go from 600 to 700 within a couple of days, and you will end up losing a lot of money. When to sell calls? Make sure the trend is downward, or at least you think stock may not go above a resistance level. That's when you sell a stock or sell the call. Duration, because you don't want yourself to be exposed for a long time. Generally, we recommend 45 days till expiration when you sell options. Strike price, typically make sure you're well under 30 delta. 15 or below is actually recommended. Next, we'll quickly look at a chart here to understand this a little bit better. So suppose we have a stock which is at $40, and you think this stock may not go above 45. So in that situation, you are actually a little bit bearish on the stock. So you can sell a call option at 45 strike price for an expiration within 45 days or so. For that, in this scenario, you're collecting a $200 premium. So if the stock remains within $45 by expiration, you'll keep the entire $200, the premium that you collected. But if the stock goes up and shoots up to say 50 or so, in that scenario, you will start collecting or generating the losses. So the moment stock price goes above the strike price, in this case 45, you'll start accumulating the loss. So from a terminology perspective, if you sell the option at the current price, say 40, we call it at the money option. If you sell the option above the current price, which is 40 in this case, we call it out of the money option. And if you sell it below the current price, it's the in the money option. Typically, when you sell a call option, you are better off selling out of the money options. In this case, we sold a 45, which is out of money call option. So with that, what to watch out? What are the key considerations? So from a pro perspective, you can generate a income when done right. So you can keep selling the call 45 days out, hoping it will expire or hoping you'll benefit or profit. So that's a good way to generate profit. But on a con perspective, a short call exposes us to uncapped risk if the stock price advances exponentially. Maybe it's a takeover candidate, so in which case stock price can go up and you will incur huge amount of loss. From a mitigation perspective, you got to make sure there is a clear area of resistance above the current stock price, and you can try to sell the call at that resistance level or a little higher than that. Avoid high flying growth stocks if possible, because they can raise exponentially. And make sure you have a stock or a call option, so that way even if the stock goes up, because you own the stock, you don't incur a huge amount of loss. A better alternative is to really sell a call vertical spread or a put option, so that way you don't incur too much loss. So, these are some things to look for, and avoid stocks that are trending up, and avoid the stocks with the accelerating revenue growth and accelerating margin, and stocks with a low debt level, and also avoid acquisition targets. For example, a technology stock or a biotechnology startup, they could be a target for acquisitions, in which case their stock price can shoot up. And if you sold a call option, you could rake up a lot of loss. What to watch out for? Increase in volatility. So when the volatility increases, if the stock is above your strike price, you could incur a lot of loss. So you got to make sure when you sell call option, at that time volatility is high, and gradually it goes down. And if the stock price raises above the strike price, you got to watch out, because you can start incurring losses heavily after that point. So with this, let's quickly go to Thinkorswim platform, and we can look at how do you sell a naked call. Let me switch over to Thinkorswim platform. We are on October 5th here, and let's look at two of our favorite stocks. First one is let's look at Tesla, which don't um, I don't recommend selling call option for Tesla, but for the argument's sake, let's see what happens. So let's look at the chart here for Tesla. So we are on October 5th here, and you could argue, Tesla made the high here at 499. You could think maybe 500 or 550 could be the ceiling. May not go beyond that within next 45 days. If that is your assumption, you could go and sell a call option for Tesla, in this case 46 days out. So let's go here, and current stock price is 431. Let's go well beyond it. So if you see here, this is the delta here. Typically we recommend 15 delta or higher, or lower actually, to sell a call option. Let's sell 15 delta in this case, and collect $9.30. Done. So let's also take one more stock, maybe a high flyer, like say Shopify as an example. Let's take Shopify here, and sell a call option here again. Let's go back to chart for Shopify. And Shopify also, you could argue, hey, what, around say 1164, that could be the ceiling. It may not go above that. If that's your assumption, you could go to trade tab here, and 46 days out is good enough, and look at maybe say around 15 delta. So if you see here, we got 10 delta, say around 15 delta right here. So I could, for the argument's sake, let's say we sold a 15 delta right here. All right, so with this, let's go to our monitor tab and see what we have done so far. So let's look at single here, Tesla. We bought a Tesla, we sold a Tesla call, strike price 640, expiration November 20th. And also we sold a call here, which is Shopify, and expiration number 20, and we collected $17. With this, let's go to expiration date, in this case November 20, and see how are our positions doing. And as it is buffering, let's also go to the chart to see how is the price. So this is Shopify. We sold around October 5th, so somewhere here. So looks like price has come down from that point. So we should be making some money here. And if I do same thing for Tesla, so Tesla we sold, around October 5th again, somewhere October 5th, right here somewhere. Um, yeah, so price was 10, Yeah, I think Tesla price probably went up a little bit. We might be, let's see how we did because we did go well above. So with that, let's look at Tesla here. Looks like Tesla, by selling a call option, we made around $938.50. Even though price went up, we sold a 640 strike, and right now Tesla is at 499. That's why we made the money in Tesla call option. Let's go ahead and close it. And right now it's trading at 1 cent because it's expiration day. Let's see if we can get a close for 5 cents. Think of some platform on demand, typically a little slow to close. That's fine. So if you look at this here, Shopify, we sold this right here, and it looks like we made a $1,700 profit, which is a good thing. Let's try to see if we can close this position out. Maybe let's try to say, pay 15 cents to see if that closes. All right. So overall, what did we learn? So what we learned is really when you sell a call option, make sure you go well above the resistance level, which is typically above the stock's current price, and typically sell at delta 15 or even lower delta. So that way, your risk level is a little bit low, and also make sure stock is kind of trending down or sideways, so stock is not going up exponentially. Those are the two key callouts that we should be making. But if you think stock is really going up, make sure at least either you own the stock or at least you have a call option which you purchased previously, so that way you can mitigate the risk. Or if it goes above your strike price, try closing the position right away, so that way you don't incur more loss. So with that, we'll quickly wrap it up. Thank you very much and have a happy trading.